Hey everyone, welcome back to Corporate Decoder, the place where we try to make sense of what companies are really saying in their filings. Today we're diving into Veradigm Inc, and let's just say they've been busy tinkering with their shareholder rights. It's like they're constantly adjusting the rules of the game for their investors. So what's the big news with Veradigm? Well, they've just dropped another amendment to their shareholder rights agreement. Now, on the surface, that might sound incredibly dull, but these agreements are actually pretty important for how the company is run and how easily someone could try to take it over. Let's unpack what this latest tweak really means for Veradigm and its shareholders. Alright, so Veradigm, much like many companies, has what's called a stockholder rights agreement. Think of it as a special set of rules designed to protect the company and its existing shareholders from hostile takeovers, where someone might try to buy up a bunch of stock quickly and gain control. This agreement has been around since February of 2025, but as you can see, it's been extended and changed multiple times. And today we're talking about the Fifth Amendment signed on August 2020 of 2025, but as you can see, it's been extended and changed multiple times. And today we're talking about the Fifth Amendment signed on August 2025. Basically, this filing is telling us that an important document, the Stockholder Rights Agreement, has been updated for the fifth time. This isn't just a minor paperwork adjustment. Each amendment is like a strategic move, and these frequent changes suggest the company is actively managing its shareholder landscape. The core of this news is that the expiration date for this rights agreement has been pushed back again. It was supposed to end on August 2025, but with this new amendment, it's now extended all the way to February 2026. This means their defenses against someone trying to acquire a large chunk of the company are staying in place for longer. They've also made some key changes to who is considered a passive investor and what percentage of shares triggers certain actions. Originally, if someone wasn't a passive investor and they managed to own 10% of the company's stock, it would trigger the rights plan. Now that threshold has been doubled to 20%. This gives a potential acquirer more room to buy shares before the poison pill associated with this agreement kicks in. Why would they do this? Well, sometimes companies want to encourage longer-term investment without triggering these protective measures. Or they might be anticipating a period where significant stock purchases are expected, either from strategic investors or perhaps even themselves. By raising the threshold, they avoid unnecessary activation of the rights plan, which can be disruptive. This section essentially confirms that these changes to the shareholder rights agreement are significant enough to warrant this specific type of filing. It's all about making sure investors are aware when the rules governing their ownership stake are being altered. The fact that item 3.03 is directly referencing item 1.01 reiterates that this isn't just a simple update. It's a material modification to how security holders' rights are managed. And of course, to make sure everyone is in the loop, Veradigm also issued a press release about these changes. Regulation FD, which stands for fair disclosure, means that when a company shares material information, they have to share it with everyone at the same time, not just select people. So this press release is their way of making this news public knowledge. This press release, which is filed as an exhibit, would typically highlight the company's reasoning for the extension and the changes. While I can't see the full text of that press release here, based on the filing, it's safe to assume they're framing this as a positive step to ensure stability and protect shareholder value during what they might perceive as a critical period. And it's important to remember that Veradigm Inc is involved in the healthcare technology sector. Its stock, NDRX, trades on the OTC expert market. This usually means it's not as actively traded or as easily accessible as stocks on major exchanges like the NYSE or NASDAQ. It's more of a niche market. Companies in this space often deal with complex regulations and rapid technological changes. So having to deal with complex regulations and rapid technological changes. So having a stable shareholder base and clear control mechanisms is crucial. Think about it like this. If you're running a lemonade stand and suddenly a lot of people start buying up all the lemons without talking to you, you might want a special rule that says if someone buys more than 10% of the lemons, you get to issue more lemonade to everyone else, diluting the impact of those big lemon purchases. That's a bit like what these rights plans do. They make it more expensive and complicated for any one person or group to accumulate a controlling stake. The frequent amendments to this agreement, first extending the expiration, then changing definitions, then adjusting percentages, suggest a company that is either very proactive in managing its ownership structure or perhaps facing ongoing pressures or interest from potential investors. It's not uncommon for companies to use these rights plans, but doing so this many times, especially with changes to the core triggers like the specified percentage, certainly indicates a company that is actively managing its takeover defenses. This specific document, Amendment Number 5, is the latest piece of that puzzle. The key takeaways here are the extended expiration date to February 2026 and the increase in the triggering threshold for non-passive investors from 10% to 20%. And finally, as with any official filing, we have the signatures. This confirms that a duly authorized person from Veradigm Inc, in this case Eric Jacobson, Senior Vice President, Deputy General Counsel and Corporate Secretary, has signed off on this report. It's a formal indication that the company is acknowledging and submitting this information as required by law. So what does this all mean for Veradigm? Well, the extended rights agreement and the higher thresholds suggest they are prioritizing stability and control over immediate flexibility for large investors. This could mean they feel the company is on the cusp of something important, whether it's launching new products, undergoing a restructuring, or perhaps fending off unsolicited interest. From a strategic standpoint, maintaining these defenses can be a double-edged sword. On one hand, it provides a buffer. On the other, it can sometimes deter legitimate strategic partners or investors who might see the company as closed off. For Veradigm, operating in the often volatile tech and healthcare sectors, this prolonged defense period might be a necessary measure to execute its long-term strategy without constant disruption. It's hard to give a definitive financial assessment without seeing their actual financial statements in this particular filing, as this 8K is primarily focused on the rights agreement. However, the consistent need to amend and extend these protective measures could imply that the market sees potential in Veradigm, or perhaps that there are parties interested in the company that warrant these strong defensive actions. The decision to raise the trigger to 20% is a notable shift, indicating a willingness to allow for more substantial initial stake building before the rights plan is activated. In conclusion, Veradigm is for now playing it safe by extending its shareholder rights agreement and slightly loosening the initial trigger point. This suggests they're focused on maintaining internal control and stability as they navigate the dynamic healthcare technology landscape. Whether this strategy proves beneficial in the long run will depend on their ability to execute their business plans and whether these defenses ultimately attract or deter the right kind of investment. And that's our breakdown of Veradigm's latest filing regarding their shareholder rights. What are your thoughts on these maneuvers? Does it signal strength or caution? Let us know in the comments below. If you found this deep dive useful, please hit that like button and subscribe to Corporate Decoder for more straight up insights into company filings. Also, don't forget to join our Discord community. The link is in the description for even more discussions. Thanks for watching, and we'll see you on the next one.